Silver didn't just close higher on Friday. It closed at $67.14, and that single number has just put multiple bullion banks into a weekend panic. Because when silver closes like this, the risk is no longer the price. The risk is who doesn't survive the open on Sunday night. In the next 3 minutes, I'm going to show you what exactly it broke on Friday, why short sellers are trapped right now, and the one mistake silver holders must not make if we gap up. To most people, 67.14 looks like a strong weekly close. To a risk manager at a major bullion bank, it looks like a systems failure. For nearly 40 years, silver has followed a very predictable script. Rallies early in the week, heavy selling on Friday, psychological pressure into the weekend. That script was executed on Friday, and for the first time in decades, it didn't work. Commercial banks tried to force silver below $65. When that failed, they defended $66. They fired everything they normally fire. And yet, silver didn't just hold. It closed at the absolute high of the week. That matters because it tells us something dangerous. There was no selling pressure left to close. The sellers were exhausted. The buyers were not. Here's where this becomes a nightmare for the shorts. Most short positions in silver are not small trades. They are leveraged institutional bets, and those bets assume one thing, that Friday weakness always appears. When silver closed at 67.14, those models broke. That close represents a 3 sigma event, the kind that risk software is not designed to handle in real time. And now comes the most dangerous part. The market is closed. Short sellers cannot hedge, they cannot exit, they cannot reduce risk. They are locked into losing positions for 48 hours while the global news cycle keeps moving. This creates something every bank fears, gap risk. If silver opens just $1 higher on Sunday night, losses expand instantly. If it opens at 70, margin calls begin before most people finish their breakfast on Monday. And that's why the next move in silver is unlikely to be calm. In a moment, I'll explain how forced buying actually works and why the first move after the open is often the most deceptive. Because if you chase that move, you will likely be the one providing liquidity to institutions trying to escape. In a managed price environment, the banks dictate the range. In a price discovery environment, the physical shortage dictates the range. And right now, the physical market is screaming that silver is undervalued. And this is where theory turns into behavior. Because when price control breaks, the next question is simple. Who was buying, and why were they buying so aggressively into the close? The buyers who stepped in at the close were not day traders flipping for pennies. They were aggressive institutional accumulators. They bought the offer, they cleared the order book, and they pushed the price up until the final bell rang. This behavior indicates fear, not the fear of losing money, but the fear of being left behind. These buyers understand the macroeconomic landscape. They see the geopolitical tensions, the supply chain fractures, and the monetary debasement. They decided that owning silver at $67 was safer than holding United States dollars over the weekend. Now consider the position of the commercial short seller. You are a major bullion bank. You sold silver at $64, promising to deliver it at a later date. Your business model depends on the price dropping, so you can buy that contract back at $60 and pocket the difference. But the price is now $67.14. You are losing more than $3 an ounce on tens of millions of ounces. Because the market is closed, you are essentially in prison. You are forced to watch the global news cycle unfold without the ability to react. You must watch reports of Samsung battery shortages and solar panel production halts go viral. Every headline increases the pressure because you know that when the Asian markets open on Sunday night, every trader in Shanghai and Singapore will have read those same headlines. This creates a psychological pressure cooker known as gap risk. If the Asian markets open the price at $68, your loss expands instantly without you ever having a chance to cover. The risk managers at these banks are currently running stress tests, asking a single terrifying question. What happens if silver opens at $70? Is the bank solvent? If the answer to that question is negative, the bank has only one choice. They must issue a market on open buy order. They must instruct their traders to buy back the short positions at any price the moment the market opens on Sunday. This is the mechanism of a gap and go. It is the release of pent-up panic. We are set up for one of the most violent market opens in financial history. 67.14 is critical because it clears the historical noise. Technically speaking, the price range between $60 and $65 was full of chopping battles between buyers and sellers that left a lot of transactional history. But above $67, the air is thin. If you examine the monthly charts going back 40 years, there is almost no trading history at these levels. We are entering what analysts call blue sky territory. There are no bag holders investors who bought high years ago and are waiting to sell to get their money back. Everyone who holds silver right now is in profit. And investors in profit Do not panic sell. They hold for the trend. This removes the overhead resistance. The only barriers left are psychological round numbers, $70, $75. These are not structural walls. They are merely mental checkpoints. However, we must remain analytical. A vertical move in price attracts tourist gamblers who use massive leverage because they believe the asset can only go up. These speculators are the weak hands. They place their stop losses very close to the current price. If the banks can engineer a $2 drop on Monday morning, they can flush these gamblers out. Their forced selling would accelerate the drop, creating a temporary correction. While 67.14 is incredibly bullish, it increases the volatility risk. The higher the price goes in a straight line, the more violent the necessary correction will be. But understand the distinction. A correction is a healthy pause in a trend. A crash is a change in the trend. Given the fundamental shortages we are seeing in the physical market, a crash is statistically unlikely. Any drop in price will likely be met by the same aggressive buying we saw on Friday. We have established the anomaly of the price. Now we must look inside the machine. We need to understand the specific mechanism that turns a bad trade into a systemic crisis. The weekend margin call. Most retail investors believe that margin calls are instantaneous. On a personal trading app, if your account drops below zero, the computer automatically closes your position. But for institutional money, the whales who trade billions in notional value, the process is slower, more bureaucratic, and far more dangerous. Institutional trading operates on variation margin. At the end of every trading day, the exchange runs a settlement process. They calculate who won and who lost. The losers are required to wire cash to the exchange to cover the difference and restore their initial margin. On a typical Tuesday, this is a routine administrative task. A few $1 million moves from Bank A to the clearinghouse. But Friday was not routine. The move to 67.14 was a violent deviation. It caught the short funds completely off guard. Many of these funds were leveraged to the hilt, betting heavily on the standard Friday pullback. When the closing bell rang, they were staring at mark-to-market losses that exceeded their liquid cash on hand. This triggers a crisis sequence on Saturday morning. The prime broker, the massive bank that facilitates trades for hedge funds, makes a phone call to the fund manager. The conversation is not a negotiation, it is a demand. You are down $500 million. You have exceeded your credit limit. We require a wire transfer of $300 million by 8 a.m. Monday morning. The fund manager is paralyzed. The banks are closed. He cannot sell other assets, stocks, bonds, or real estate to raise the cash because those markets are also closed. He is illiquid. The prime broker's response is standard and ruthless. If the wire is not received by 8:01 a.m., we will liquidate your position. This is the mechanics of forced liquidation. It does not matter if the fund manager believes silver will crash next week. It does not matter if his long-term thesis is correct. He has failed the liquidity test. The bank takes control of the account, and the bank's risk algorithm has only one instruction: reduce risk to zero. Since the fund is short silver, reducing risk means buying silver contracts. Buying at any price, buying until the risk is zero. The algorithm does not care about value, it cares only about solvency. This mechanism is the primary driver of a gap-up opening. When you see the price jump vertically on a Monday morning, it is rarely caused by eager investors rushing to buy because they love the asset. It is caused by banks rushing to buy because they are terrified of their own clients defaulting. The computer hits the buy button repeatedly, absorbing every available contract, driving the price higher in a vacuum of liquidity. We are looking at a potential cascade of defaults. This is the domino effect of counterparty risk. If the forced liquidation drives the price from $67 to $68, that new price level triggers the margin calls for the next tier of short sellers, those who are slightly better capitalized but are now also underwater. One fund fails, driving the price up, which causes the next fund to fail, driving the price up further. The first domino has already tipped over. We are simply waiting for gravity to take effect on Monday morning. We must now shift our focus from the digital ledgers of Wall Street to the physical reality of the supply chain. While the paper market is paralyzed by math, the physical market is paralyzed by a lack of metal. The online bullion dealers, local coin shops, and wholesale distributors are currently in a state of shock. To understand why, you must look at the business model of a bullion dealer. They operate on thin margins, relying on volume rather than speculation. They act as a conduit, buying from a wholesaler and selling to the public, capturing a small premium in the middle. Imagine you are a coin dealer. On Friday morning, when silver was trading lower, you sold 1,000 ounces of silver eagles to customers for $64 an ounce. You took their cash. You issued a confirmation email promising to ship the metal. Your plan was standard. Call your wholesaler on Monday morning, buy the replacement metal for $63, and pocket the $1 spread. But the market has moved against you. The spot price is now $67.14, and the wholesale premiums are rising rapidly. To replace the inventory you just sold, you might have to pay $70 an ounce. You have locked in a loss of $6 an ounce on 1,000 ounces. You are bleeding working capital. This is known as replacement cost risk. In a violent bull market, selling inventory becomes dangerous for the middleman. If you sell your stock and the price jumps before you can restock, you essentially sell yourself out of business. You trade a hard asset for depreciating currency, only to find you cannot afford to buy the asset back. So how do dealers react during a weekend like this? They freeze. If you navigate to the major bullion websites right now, you will observe one of three defensive postures. First, sold-out banners appear on almost every product. This is often a deception. They likely have inventory, but they are hiding it to prevent selling at a loss. Second, maintenance mode screens appear. The dealers literally shut down their websites to stop the bleeding. Third, they expand the premiums massively. They might raise the price to $80, not because that is the market price, but to discourage buying until they can assess the damage on Monday. This defensive behavior creates a physical vacuum. The demand from the public is exploding because the price is rising, but the supply has vanished because the sellers are terrified. It is the perfect storm for a price squeeze. Buyers with cash, sellers in hiding. The only way to coax the inventory back onto the market is to bid the price much, much higher. However, there is a bigger game being played at the very top of the wealth pyramid, involving unallocated accounts. Major banks hold billions of ounces of silver on behalf of wealthy clients and family offices. The vast majority of this silver is unallocated. This means the client does not own specific bars with serial numbers. They own a claim on the bank's general pool of metal. The bank uses this pool to lease silver to industry, to hedge, and to facilitate trading. It is, in essence, a fractional reserve system for metal. When the price hits $67 and rumors of shortages begin to circulate, these wealthy clients lose confidence. They ask the critical question, does the bank actually have my silver? We are receiving reports of a quiet high-net-worth bank run on the vaults. Family offices are sending urgent instructions to convert their unallocated holdings to allocated status. They are demanding that the bank take specific bars, place them on a segregated shelf, and issue a warrant with the serial numbers. This request forces the bank to show its hand. If the bank has the silver, they simply move it. But if they do not, if they have leased it to Samsung or sold it to China, they are in a crisis. They cannot tell a billionaire client, we don't have it. That would trigger a lawsuit and a total collapse of confidence in the institution, so the bank quietly goes into the market and pays whatever is necessary to secure the bars. They pay $68, they pay $70. This internal squeeze is invisible to the retail trader, but it is the driving force behind the resilience of the price. The banks are bidding against each other to secure the metal they owe to their own clients. They are trapped in a web of their own rehypothecation. When the bell rings on Sunday night, we have a convergence of three desperate groups: hedge funds facing margin calls, dealers desperate to restock inventory, and banks covering unallocated deficits. Who is selling? Nobody. The miners are not selling at these levels. They are holding for higher prices. The stackers are not selling. This imbalance, massive forced buying versus zero willing selling, creates the conditions for a price gap. The price teleports. It might close Friday at $67.14 and open Sunday at $68.50, skipping all the prices in between. This is the ultimate nightmare for the shorts, as they are denied the opportunity to cover their positions at a reasonable loss. The financial panic in New York is only half of the story. While the West fights over paper contracts, the physical metal is moving. It is leaving the vaults of London and New York and flowing east. To understand why the West is running out of silver, we must look at the arbitrage spread. Arbitrage is the force of gravity in economics. Capital and goods always flow to where they are valued most highly. Right now, the COMEX in New York closed at $67.14. However, the Shanghai Gold Exchange in China is trading significantly higher. Due to intense industrial demand from the solar and battery sectors, silver in China is trading closer to $72. This $5 gap is a massive anomaly. In the world of commodities, a spread of this magnitude acts like a black hole with infinite gravity. If you are a global refiner or a wholesale vault operator, the math is undeniable. Do you send your silver to New York to sell for $67? Or do you send it to Shanghai to sell for $72? You send it to Shanghai. Every single bar that is not legally encumbered is being placed on a pallet and flown to China. This creates a severe supply shock in the West. The metal that usually replenishes the COMEX vaults is being diverted. The metal that usually sits in London is being withdrawn. This is the Shanghai magnet. It is sucking the liquidity out of the Western financial system. And because the Western markets are closed this weekend, The spread is likely to widen even further before New York opens. While New York sleeps, the metal leaves. There is a distinct possibility that when the American markets wake up, the cupboards will be bare. The inventory data from the COMEX supports this. We are watching the registered category, the silver available for immediate delivery, evaporate. For years, this number has been dropping. It has fallen from 150 million ounces to 80 million, and now it sits precariously near 30 million. With the price at $67, we are entering the danger zone for a delivery default. The short sellers who are trapped have two bad choices: pay billions in cash to close the position or deliver the physical metal. They would prefer to deliver the metal, as it is cheaper than buying back the contract at a loss. But they do not have the metal. They cannot source it from London because Shanghai has already claimed it. They cannot source it from the miners because the industrial giants have already bought it. So they are forced to raid the COMEX registered inventory. We are watching the eligible category. The private piles of silver sitting in the vault remain flat, while the registered public pile evaporates. If the registered inventory hits zero or gets close enough to zero to cause a panic, the exchange breaks. They would be forced to declare force majeure and settle contracts in cash. This weekend, traders are doing the math on the cover ratio. How many paper claims exist for every single physical ounce available at $67? That ratio is exploding. The higher the price goes, the more contract holders demand delivery. The more people want delivery, the faster the vault drains. The faster the vault drains, the higher the price goes. It is a feedback loop that ends with the destruction of the paper market. While the banks play poker with paper contracts, the industrial sector is playing a game of survival. There is a massive drain on supply that you will never see on a standard price chart: direct procurement. In a normal market, companies like Samsung, Tesla, or Apple might use the futures market to hedge their costs. But in a shortage, futures contracts are useless. You cannot build an electric vehicle with a paper contract. You need the physical atoms in your factory to keep the assembly line moving. So what are these industrial giants doing this weekend? They are executing off-market deals. They are bypassing the exchanges entirely. We are seeing evidence of major manufacturers calling mining companies directly. The conversation is simple. We will buy your entire production for the next 2 years. We will pay you $70 an ounce, and we will pick it up at the mine gate. This is catastrophic for the COMEX. The exchange relies on the excess silver from miners flowing into its vaults to back the contracts. But if Tesla buys the silver before it even leaves the ground, that silver never reaches the financial system. It disappears from the public ledger. We are witnessing a bifurcation of the market. There is the public market, where crumbs are traded back and forth by speculators, and there is the private market, where massive tonnage is being locked up by strategic industries. The public market thinks there is plenty of silver. The private market knows there is none. This weekend, while the screens are dark, the private market is busy securing the last remaining stockpiles. By Monday morning, the available inventory will be lower than it was on Friday. This leads us to a controversial, yet necessary truth. The spot price is broken. For 40 years, the world accepted that the price discovered on the futures exchange was the real price. But that mechanism assumes that you can easily turn paper into metal. That assumption is failing. If you go to a wholesale distributor today and say, "I want to buy silver at the spot price of $67.14, they will likely laugh. They will tell you, "Good luck, our price is $78. The spot price has become a reference rate for paper gambling, not a purchase price for physical goods. This divergence is the death knell of a currency system. We saw this in the Soviet Union. The official rate for bread was low, but there was no bread. The black market rate was high, and you could actually eat. We are entering a phase where the physical premium is permanent. It is not a temporary surcharge. It is the real price asserting itself against the artificial price. So when you look at $67.14, do not think that is the value of your portfolio. Think of it as the lie they are telling to keep the system calm. Your metal is worth what someone will pay for it. And right now, desperate industries are willing to pay much, much more than the screen says. We have analyzed the anomaly, the banking crisis, and the physical shortage. Now we must address the immediate future. The silence of Saturday is deceptive. It is merely the deep breath before the plunge. In less than 36 hours, the Asian markets will open for the new week, and the banks, the hedge funds, and the industrial buyers will all rush through the same door at the same time. For silver investors, Sunday evening is usually quiet, but this Sunday will be the Super Bowl of finance. At 6 p.m. Eastern Time, the Globex futures market opens. This is the first chance the world gets to vote on the Friday close. Here's the scenario you must prepare for: the gap and go. If the panic is real, and if the margin calls we discussed are enforced, we will see the price open significantly higher than $67.14. It might open at $68. It might open at $68.50. This creates a gap on the chart empty space where no trading occurred. Psychologically, this is powerful. It tells the market that the asset is so valuable, nobody was willing to sell it at the old price. However, there is a danger here: thin liquidity. On Sunday night, trading volume is low. It is easy for a major player to push the price around. Sometimes banks will use this thin liquidity to engineer a fake drop. They might sell a few hundred contracts to make it look like the open is weak, attempting to scare retail investors before the real volume arrives on Monday morning. Therefore, the rule for Sunday night is simple: watch, but do not touch. Unless you are a professional futures trader, do not try to trade the Sunday open. The spreads are wide, and the volatility is extreme. Let the banks fight it out. Wait for the dust to settle on Monday. Let us assume we gap up to $69 on Monday morning. You wake up, check your phone, and see green. You feel a rush of adrenaline, the fear of missing out. Your instinct is to buy immediately before it goes to 100. You must resist this instinct. Markets rarely go up in a straight line forever. There's a technical phenomenon called filling the gap. Often, after a massive jump, the price will drift back down to the level where it broke out. It comes back to test the breakout, ensuring it is real support. If you buy the panic spike at $69, and then the price drifts back to $67 to fill the gap, you are down $2 instantly. You feel foolish. You panic sell. And then the price rips to $70 without you. Do not chase the rocket. If you are already holding silver, enjoy the ride. If you are looking to buy more, wait for the retest. Wait for the price to come back and kiss the $67 level. If it holds there, that is your entry. Patience pays. Chasing gets you punished. We must also discuss the next target: $70. Why 70? Because it is a big, round number. It is a psychological milestone. But more importantly, it represents the final capitulation of the bear case. Below $70, the skeptics can still argue that this is a correction. They can draw lines on a chart and claim it is a double top. But if we break $70, the chart becomes vertical. The bearish thesis is destroyed. This means that $70 will be a war zone. The banks will defend it with everything they have. They will place massive sell walls at $69.99. Expect turbulence as we approach that number. We might hit $69.50 and bounce off. We might chop around for a few days. This is normal. It is the market digesting the gains. Do not mistake a pause at 70 for a top. It is simply the market refueling before it breaks the sound barrier. Finally, I must play devil's advocate. I must give you the downside scenario so that you are protected. What if this is all a trap? What if the banks have one last trick? There is a scenario where they use the Sunday night illiquidity to stage a massive rug pull. They could dump billions of paper contracts to drive the price back below $65. Their goal would be to break the spirit of the bulls and trigger the stop losses of the people who bought the Friday high. If we see silver drop below $65 on Monday, that is a warning sign. It means the breakout might have been a fake out. It means we might need more time to consolidate. If this happens, do not panic. Remember the fundamentals. Remember Samsung. Remember China. A paper smash does not change the physical shortage. It just gives you a better price to accumulate. But understand that volatility cuts both ways. If you are leveraged, a rug pull can wipe you out. This is why the smartest play is to hold physical metal. Physical silver cannot be margin called. It sits in your safe. It ignores the rug pull. It waits for the truth to return. Let us zoom out one last time. Whether we gap up to 69 on Monday or pull back to 66, the verdict of this weekly candle is undeniable. We closed at the highs. We absorbed the selling. We broke the suppression. The trend has changed from down to up. The psychology has changed from fear to greed. The flow of metal has changed from west to east. You are holding an asset that is currently being repriced by the entire world simultaneously. This process is messy, it is violent, it is scary, but it is profitable. The banks are having a nightmare weekend. You should be having a great weekend. You did the work, you did the research, you bought the metal. Now let the market do the rest. Stay sharp, stay stacked, and watch the open.